Is Thor Industries stock, ticker symbol THO, a potential buy now? We're using the Select 6 analysis to look at the most telling financial metrics before estimating a fair value for Thor Industries. Then you'll want to stick around as we give a rating to the business. There'll be a key bonus metric along the way that just might be the tipping point when analyzing Thor Industries for your stock portfolio. This analysis is going to be intense, but it's going to be worth it. Before we get into these valuable metrics, how has Thor Industries stock performed? Right now, Thor Industries trades for $95.13 per share. They trade $27 above their 52-week low, down $21 from their 52-week high. There's a ton of short interest in the business, with 9% of their shares sold short. Thor Industries has a $5 billion market cap. Year to date, they're beating the market by a lot. Thor Industries is up 26%, while the S&P 500 is up just under 12%. In the last 10 years, however, Thor has underperformed the market. They're compounding at 5.5% annually. Thor is in the RV industry, which has been cyclical throughout its history. Although Thor has managed to be profitable throughout this cyclicality, going back before the global financial crisis, in the last 18.5 years, Thor has compounded at 7% annually. Keep in mind, right now, Thor pays a 1.89% dividend yield. Their average dividend yield is added to any gains in their stock. But the burning question is, why should we be paying close attention to Thor Industries? Thor Industries is a manufacturer of recreational vehicles through its subsidiaries. The company reports through three segments: North American towable RVs, North American motorized RVs, and European RVs. The North American towable business segments operate by brand: Airstream, Heartland, Jayco, Keystone, and KZ. North American RV does the same through Airstream, Jayco, and Thor Motor Coach brands. Thor's European RV business consists solely of the Erwin-Heimer Group, which manufactures both towable and recreational vehicles in Europe. EHG's operations include miscellaneous RV-related products and services. Across all segments, the firm distributes its RVs to independent dealers. Now with that background on the business, it's time to dive deep into their numbers. Starting with metric number 1, we want their average return on capital in the last 5 years to be above 14%. A typical business earns a 7% return on capital. Looking for a benchmark that's double this can build in margin of safety based on the quality of the company. RVs are a cyclical industry. Thor will see cyclical returns on capital. On the balance, we want these to be above average. We see a little bit of that cyclicality showing through here. The business really skyrocketed in 2021 and 2022 on the back of a huge increase in demand because of lockdowns. In the last 5 years, while these are relatively lumpy, when we average them out, Thor earns 15.4% average returns on capital in a given year, just a percentage point and a half above our benchmark, but more than double that of a typical business. This is a strong check on metric number 1 for Thor. Metric number 2, we want to see growth in their revenues, net incomes, and free cash flows. All three need to be up for it to be a check. In this time, Thor has grown their revenues by 41%, their earnings have nearly tripled, and their free cash flows have more than doubled. Because their net incomes and free cash flows grow faster than their revenues, the company's margins are up over this time. They're experiencing some operating leverage as they're getting more profitability out of their fixed assets. It's great to see this growth, especially led by the profitability metrics for Thor. This is another huge check on metric number 2. Metric number 3, we want earnings per share growth. We learned in our last metric, Thor has nearly tripled their net incomes, aka their earnings. At the same time, the company's bought back just a tiny amount of shares, less than 0.5% of share buybacks. This earnings per share growth is almost all on the back of their earnings, which are close to tripling over this time. It's another check on metric number 3 for Thor. Metric number 4, we want to see free cash flow per share growth. A similar situation here. Their free cash flows have more than doubled with just tiny share buybacks. These lead the charge on their free cash flow per share growth. A check here on metric number 4 means so far through our first 4 metrics, Thor is a perfect 4 for 4 on our analysis. Can they keep this up? We'll find out right after we cover our bonus. Right now, Thor pays a 1.89% dividend yield. As our bonus, we want their dividends to be supported by their free cash flows. Thor has grown their dividends in each of the last 5 years, and over this time, they've grown their free cash flows as well. They've supported their dividend growth throughout this period. That's also the case today. They maintain a healthy dividend payout ratio. It's exactly what we're looking for. This is a check on our bonus. Even with cyclicality, Thor's generated a lot of free cash flow in the last handful of years. In recessions, it's businesses with lots of debt that can go bankrupt and have the biggest losses. Metric number 5, we want their net debt, which is their total debt minus their cash and their short-term investments, to be below the sum of their free cash flows in their last 5 fiscal years. In this time, Thor has reduced their net debt position. Right now they have $912 million in net debt. At the same time, when we add up their last 5 fiscal years, Thor's produced $2.7 billion of free cash flow. That's easily enough to support their net debt position. This is a big check on metric number 5. Thor's produced $773 million of free cash flow in their last 12 months. They could pay off all of their net debt in just over a year and a quarter's worth of free cash flow. It looks like the business's balance sheet is in healthy shape. Flawless through our first 5 metrics, let's find out if Thor has what it takes to go 6 for 6 on our analysis and be a perfect select 6 stock. The big metric of them all, metric number 6, we want Thor's average 5-year free cash flow divided by their enterprise value to give us a yield that's above 5%. If this is the case, this gives a slight risk premium to the yield of the 10-year treasury. It's the first of 2 different ways we'll estimate a fair value for Thor. Right now, Thor has a $6 billion enterprise value. This accounts for both their net debt position and their market cap. It looks at the business similar to Thor being a private company. In the last 5 years, we learned they produced $2.7 billion of free cash flow. This means they produced $546 million in an average year. When we divide that by their $6 billion enterprise value, we get a 9.1% average free cash flow to enterprise value yield, more than double the yield from the 10-year treasury. On a current basis, Thor produced $773 million of free cash flow in their last 12 months. When we divide that by their enterprise value, we get a 12.9% current free cash flow to enterprise value yield, nearly 4 times the yield of the 10-year treasury. Both of these are massively above that treasury yield. They're well above the risk premium we're looking for as well. With a check here on metric number 6, Thor's done it. They're a perfect select 6 stock. Don't just run out and go buy the business. We're not finished. We still need to estimate their fair value per share and talk about our rating. Everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze Thor Industries. This takes us on to using a discounted cash flow model to estimate their fair value per share. A DCF model is based on the predictability of a company's free cash flows. Like any model in any discipline, its outputs are sensitive to its inputs. We're starting with an average of their last 3 years of free cash flow, then using historical assumptions to grow these into the future. It's up to you to figure out if these will be accurate or not for Thor. Thor's been a highly predictable business in their past, yet they operate in a cyclical industry. It helps their industry is an oligopoly in nature. There are really only 3 major manufacturers of RVs in North America: Thor Industries, Forest River, which is owned by Warren Buffett's Berkshire Hathaway, and Winnebago, which has a large position from value investor Norbert Liu. This potentially helps their business predictability, yet it's worth keeping in mind, especially since the pandemic lockdowns, the RV industry has seen a big boom. We may be looking at a higher point for the business. Still, if we estimate that their free cash flows grow at 7.5% annually in the next 10 years, then in the following decade, if these grow at 3.5% annually, we'll add in their tangible book value to give an estimate of their net worth. If we want a 15% rate of return, which is what Warren Buffett looks for from his investments, from today's valuation multiples, if they're the same 20 years into the future, an estimate of Thor's fair value per share is around $138. That's more than $40 above their current stock price. Keep some key points in mind. Again, cyclicality is a huge factor for this business. One of the main things you want to avoid in investing is paying peak multiples for peak earnings. Thor may potentially be around peak earnings. They're trading a little bit below their average multiple of around 16 times earnings. It doesn't seem like they're at that peak valuation. Historically, they've traded around a 16 times enterprise to free cash flow multiple in the last decade. Right now, they're trading for less than half of that, closer to the low end of that range over this time. That may not be as much of an issue for Thor, although it is possible that we see demand, especially in a consumer discretionary cyclical industry like RVs, decline into the future after such a boom in demand following the pandemic. Keep in mind, most importantly, this analysis is not financial advice. It's not a buy or sell recommendation of any security. Consult with your financial advisor before making any investment decision. Now let's talk about our rating. We learned through analyzing Thor Industries, stock ticker THO, they're a perfect select 6 stock, and they check our bonus. The company has the signs of being a wonderful business, plus it looks like their free cash flow to enterprise value yields are attractive compared to the 10-year treasury. Thor operates in an oligopoly, yet the key point to keep in mind is the cyclicality of their business and the potential for consumer demand to evaporate, especially in the near to medium future. Keep in mind, this analysis is not financial advice. When we performed our discounted cash flow analysis, from today's valuation multiples, if they're the same 20 years into the future, if you believe those assumptions and you want a 15% rate of return like Warren Buffett, an estimate of Thor's fair value per share is around $138. That's coming off of a high for the business, but that's where they traded at their all-time highs in April of 2021. I'd encourage you to dig in and learn more about the business if you're interested. When we look at all the factors of our analysis, Thor looks like an excellent candidate for more research. If you enjoyed learning about Thor, like the video and subscribe to the channel for more.